So Adam, I see you here, and welcome back to F.A.C.E. I'm going to make you the presenter, and what a wild day for you and I to be talking about trading in this environment. So,
you guys hear me okay?
Yeah, got you, Adam.
All right.
I hear you.
Cool.
Welcome back to F.A.C.E., brother.
Hey, well, thanks for having me back. How's everyone doing? Can you see my screen okay?
Not yet.
All
now
right,
we can. Now we can. More than just price.
Yes. I didn't know what you wanted to do, where you want to go. I've got a potential trade that we've put out that we can talk about.
Okay. You're the boss.
All right, cool.
Okay, so I mean, wherever you want to go that you have conviction with, and whatever you want to communicate to our community, buddy, I bring you back and give you discretion. You have power of attorney over the next 30 minutes.
Fantastic. All right, cool. So just a little bit about us. This is our second time talking with Dale, which is cool. Thank you very much for having us back. A little bit about myself. I started off way back in the day at Goldman's, which was 1995, 4, something like that it was. And I left there in 2004. And I've been sailing solo from that point onwards, running a small market making business, predominantly in CME or NYMEX, obviously before CME bought it. But after that, on oil products, RBOB, heating oil or diesel, and more recently kind of dabbled into other things as well. But the backbone is the oil space. So
it's interesting. You're the guy to ask then, because last week when the S&Ps were under pressure, and there had been, especially until today, pretty tight correlation between indexes and WTI. Do you know what's behind the WTI standing on its own in the face of risk off everywhere else? What gave it the lift today?
I think, combination. I mean, we've had the Iranian, the Americans playing tough on Iran at the moment, whilst those barrels have either been made up elsewhere, or Iran's doing a very good job still of getting those barrels out onto the market, whichever means they feel appropriate. They've got different relationships with different countries. It's very hard to kind of truly stop them. I think in the US lawmakers that are assessing these sanctions are doing a cracking job attacking the companies that are potentially still working with Iran, but there's always going to be some barrels leak out. But when military, not action, but certainly military muscle is flexed, crude reacts. There's nothing, You only have to look at any form of major oil producer and associate that with any form of potential unrest. When Russia went into the Crimea, oil exploded. The Arab Spring, oil exploded. It's very sensitive to barrels off.
Okay. Do you buy the?
Sorry, go on.
Do you buy the maxim that you should never short oil on Friday, Adam?
No, I don't.
Yeah, I know. Okay. All right. I figured.
Any of these. I mean, I've seen huge kind of gap down opens on Monday. It's obviously there's some weekend risk, and there's always a bit of war or political risk, but
right.
The guys shorting oil of the week on a Friday and coming back on a Monday probably made more money than those being long it. So it's always one of those facts. I think people are more worried about political unrest.
There's some panel covering the top of your presentation, like a black rectangle square on top. Do you see that?
Right. Hold on one sec. Is that gone away now?
Thank you, Blake. No.
Hold on.
Which maybe it starts from the top. There, it's gone. Okay.
Right. Okay, fine. Yeah, it's just a pop-up. So let me put my machine on to do not disturb. Where are we? Focus assist. Okay, cool. That'll make it all go away now. Right.
Okay.
Yeah. So one of the other things as well is very sensitive, and people, whilst Libya's not really a massive producer, they have a lot of the sensitivity to changes in Libya is actually quite profound on the oil market. Normally around the fact that their barrels are readily available, their oil's very, very versatile into many refineries.
Okay.
You know,
nice.
So that's always an interesting thing. I mean, you know, kind of this whole energy independence thing for the US is always an interesting concept, because you know there's most of the refiners in the US require Arabian oil, and many of the refiners in Europe require US oil. So there's a natural shipping demand always happening and a natural import-export demand always happening. So unless someone's prepared to invest I won't say hundreds of billions, but certainly tens of billions of dollars in refinery replacements that needs to go on in the US market, you know, that play will always still be going on.
Yeah, the energy independence is lacking refining capacity here. That's a pearl. Thank you, Adam.
No worries. Okay, so what was I? So yeah, we've at MacroHedge we've got 3 products out. So one is our options, which is our flagship. I'll go through the trade that we put out recently of that. The directional, which is for those kind of not really trading options but want our kind of directional term points. The other one is our new intelligence. We had a lot of people ask questions about how does it all work and how does it all get put together. So one of the things that I wanted to do was ensure that we didn't give away our secrets per se, but we also gave some explanations to the background as to how we work a trade, work a strategy. And I was just going to talk everyone through that today so they can actually see it kind of pieced together and put together. So yeah, I won't dwell too much on these next slides because we've already done them. If anyone wants a copy of this, just ping me and I'll put this on share. An interesting slide we've got here, which is I've cut away the right-hand side axis so no one can see what price chart this is. But we gave this to someone to do some technical analysis on, and it's kind of spent a lot of time looking here. You can see the Fibonacci retracements, the touch points, the reverse head and shoulders, the breakouts. And one of the things we wanted to kind of just say was just we built MicroHedged Intelligence to enable traders to have something else to rely on that wasn't price action, wasn't charts, because we need to be looking at what's happening to true value. Because when we released to this trader that basically we just used a random number generator off MathWorks for that chart.
Okay.
Even though he was absolutely adamant that the chart was predicting these prices and this was about to this trend line was going to break, it was just we used a random stream class to produce that and import it into a chart. So this, whilst we understand that there's a lot of technical analysis out there in the world, we wanted to enable our customers to see something that showed not necessarily an opposing side, but something that says there are other factors at work that's going on that's worth looking at. Okay. So what have we built? So we run 4 models. Two are compressed together. So our MacroHedge market metrics, which is our trend and range model, MacroHedged implied vol, that's our proprietary volatility model. It's actually the model I use for market making in the crude. We've just rolled that out and indexerized it. And MacroHedged turn, which is basically our oversold, undersold. So we're looking at, this is our core model. We're looking at how skew is impacting the pressure on the market, which will predict the turn points, and I'll show you how that works now. Okay. So this is what the users see. There's a free trial on this of 5 days for everyone, and you see. So if we look at kind of the S&P 500, because the next example is the S&P 500, where the market trends, it was whether it's in bullish mode, neutral mode, or bearish mode, what the implied vol is in relation to the last annualized over the last year, whether it's cheap or rich. But the key ones to kind of look at are the turn models. So you see as an example that they're The call turns incredibly cheap, and even the put turns on S&P 500 are fairly cheap as well. This was this morning, so this is we've not really seen that leg up in puts, but that was arguably because of the rally we saw Friday in the S&P 500. But if we go to this next slide, we can start to see how it can impact someone's trading. You know, we're not about intraday trading. We're all about how can we assist somebody to make a gain over a longer period of time. That longer period of time could be we try and analyze over a year or quarter on quarter. But we've got a lot of day traders, technical analysis guys that use us to kind of assist their trading. Somebody gave us the best compliment ever a few weeks back. He said, "You guys are the sanity to my insane trading." And if we can, if the strategies we're selecting can bring you revenue that you can offset against your learning curve, then that's brilliant. So if we look here at what's going on, we've mapped back our model back into Bloomberg because to try and visualize, to help people kind of see what we're doing and what we're looking at. So if we look at the far left hand side red arrow, it's just predicting that our trend model turned. Now, our trend model is always going to be slightly late, but it turned pretty well in for the S&P 500 last year. But that to me personally is not a great source of high probability profits, and that's what we're about. But if we move over to kind of early November, you can see our put turns and our put turns were starting to completely wane, and our call turns were spiking, and our model will depict a point when everyone's overblown, and you can see the key things here are those three spikes. The first one was absolutely perfectly timed. The second one was a little bit early. It was 3 days early. And the fourth one was well timed because whilst we all thought the bottom was potentially in, it did another 300 handles further south. So that's where this becomes of great value to any day trader or anyone looking over a week's time horizon or a 2 weeks time horizon, where we will signal when our model's physically seeing these skews being manipulated, where the large money's coming in and absorbing everything for a turn point, and that's something that we've now mapped out visually. If I move over, where are we now? So this is the sterling. There's another interesting one here. If we look onto the right here, you'll see that the call values around the Brexit votes were absolutely flatlined to zero. And there's just everyone was expecting further selling in sterling, but it was to the point where it was so cheap you could have funded long positions for free, and lo and behold, look what happened. All we had was a move up from 128 all the way up to 400 points all the way up.
You could have funded them for free by writing options.
Yeah.
Okay.
I mean,
like a risk reversal where you're long a call and you sell puts and it covers it.
Yeah. I mean, it was so cheap in our model. It was just ridiculous. Even if you were wrong, you would have lost a couple of ticks because it was just. This is what I'll show you kind of coming up in the next example is this. What we're looking here is for predictable value, and the market was so sure. Everyone was wading, thinking the votes weren't going to pass and the world was going to end. And lo and behold, bang, up we go, 300, 400 points. And a similar thing happened. You can see late March, April time, where the calls just, again, the same thing. Everyone thought sterling was going to do fantastic, and Brexit's been delayed. Calls went to 100 or 1.0 in our index. And then you see that little spike there in the puts of the second arrow, and that's money moving in. And then there was around 133. We've just come off now 300 points from 133. It's looking at that when someone makes a large trade in the outright, they're impacting that outright for that moment. When someone makes a large trade in options, they're impacting the entire skew. So every single level there, that wing moving from the at the money is right the way out to the 5 deltas. Someone's physically got to smash everything. That's true money coming in and moving, and that's what we're riding with as well.
Interesting.
So, sorry, that's a off slide. So, that shouldn't say what have we built. That should say this is a trade.
Okay.
So we, using that same ethos, the same model, we looked at the 10-year notes, and you can see, since the Federal Reserve came out incredibly dovish in their December meeting, we've seen nothing but buyers of bonds, and the whole world thinks that the US market's done, and where the recession's coming, and there's going to be no more rate rises. If anything, there's going to be rate cuts. Well, what we've got ourselves here in the bond market is the same thing that we've kind of had back in that sterling market that I was talking about, and also in the S&Ps back in October, November last year, where we're so weighted to interest rate cuts that there any tone change over the next few months that's a hawkish tone change by the Federal Reserve, we'll see an incredible snap back. And what we can even look at, these are things that don't move that much. So just to highlight the point of where we were back in November and where we are, this was Friday, you can see that there's a nearly a 0.35% difference in the 25 delta puts of the 10-year. That's just, in crude oil, that would be a day's range. In the 10-year, massive. These things don't move that way. Everyone is forecasting rate cuts, no more, and a bearish outlook for the US. Now, if we have any movement and we don't even need a rate increase or even stipulation that they're not going to get a rate cut, just any hawkish tone, that snaps back. So how can we make profit from that tone change?
And with flight to quality going on today, is today a good time to execute that strategy? I mean, we haven't quite made new highs in the note. Yeah. It would look like a 3 drive, but you would start doing it on days where there's risk off and people coming into bonds, right, Adam?
Absolutely. So we started doing it. We started doing it on the 8th of May. You can get it done today, a bit cheaper. But you can look here is that, the cost of this position is 1 tick. So you can have a 1/5 short ratio spread for 1 tick. So if the market continues to go up, the Fed stay dovish, they cut interest rates again, America falls off a cliff economically, we lose a tick. But if we have any movement for positivity, more hawkish tone, continuing success with results coming out of the US, this ramps into kind of crazy levels where, we were the 10-year bonds were at 122 just 4 weeks ago. Well, if we move back down to 122, you're up 400 ticks already on this.
You mean from 1 pip to 400?
Yeah, because everyone's just written off any potential downside to US.
Wow. I'm going to put some on.
Yeah, so we look for those kind of opportunities. Keep the risk very small for our customers.
Realistically, what's your target? Where would you start ringing the register, risking one tick?
If the bonds move down to kind of even 122.5, you'll have made so much money on it, you can just throw out 50% of the position, and just have a free ride. This chart here just shows that they're worth 2.1 ticks. They're actually worth 1.4 ticks. But if we have a move down in the bonds, a slow move down, you can see this moves from 0 all the way up to 1400. Well, we're not going to get up there, but if over the next 20-30 days, if this moves from nothing or 1 tick to 400, it's an incredible rate of return.
What's the spread bid offer on that option?
You can do, the spread is 1 tick wide, 2,000 by 1,600. You can literally get as much done as you like. Okay,
wow. Fascinating.
So it's trading 1-2 at the moment. You get there's
if you go in 1.5, will they bill you if you went in between bid offer?
You
on
can't go
something
any.
like
You
that?
can't go any smaller. Yeah, you get filled straight away. I mean, you
Okay.
can do as much as you want both sides.
Okay.
That's the beauty of the bond market. You know, when they crush a strike, they crush a strike, and they do it. So,
All right.
but when they operate in a way in which they're more than happy to chase something they've done wrong. Whereas crude, you'll never get it that tight. The mini, you'll never get it there. No one's quite 100% sure. Bond market moved from kind of 99% sure to 1% sure. Like very little in between sometimes.
That's
so
something
you can really capture that. So they're the, you know, using the intelligence panel. They're the kind of trades that we put out to the customers that, you know, where this might not yield, it might, but you know, for that kind of risk, we're so highly geared in our favor. It's crazy not to be putting those on. They're simple strategies. You can park them, and it's there to complement kind of day traders. We've got customers now that have either opened options accounts and use us just for kind of either to hedge against. So they'll have an open position, but they'll be turning their day trading position with the natural hedging we're creating for them. Or
when's the expiration on this play?
They don't expire until late August, so you've got ages.
Oh, in this business, it's ages.
Yeah, you've got 78 days. So between let's say, you know, I'm not a big fan of keeping anything in the last 30 days. So, you know, let's say we've got 55 days. You know, we've got 2 more Fed meetings. Anything hawkish, this pays big time.
Man, I rarely see a setup like that, you know, where the risk reward. I mean, I've actually hit on like 10 baggers, but you're talking about 400. So and that's astronomical, man.
Yeah. The gold trade was 3 ticks when I came on with you last. I thought no, like 3.8. And you know, we sold that was
bearish.
22. So
nice.
you know, 7-8 times risk on that. We made 120 grand on that.
Nice, buddy.
Yeah, but it's just we spend our time looking for these opportunities, and you've got to stack them all up, and you kind of start acting a little bit like a venture capital money, seed money to venture capitalists. They will spread their bets quite evenly. They'll have a guy that's going to be quite a regular kind of, a service type business that you know that when you invest in that, it's just going to yield you 5-6% a year. It's like buying a property. Then you've got a couple of guys in their dad's garage that are either going to make you a billionaire or go bankrupt. And you have to spread that portfolio, your mindset across all of those types of events. And that's what we do, is we look for all of those types of events. We know the regular stuff that's always going to pay us. We know the stuff that might be a bit of a dice roll, but if it does, it's fantastic. And that's the key, because I think if you just sit there staring at whether or not, you know, the mini's going to go up or down, eventually, you know, the house wins and the casino will come and, you know, throw you out the front door. And that's what we're trying to educate and show people, that's how they should be thinking, and park these things and just leave them there and act. Everyone should be acting like they're their own venture fund manager.
Interesting. You know, I'm rooting for you to beat the house and bankrupt them. So Adam, anything you wanted to wrap it with, or you want to go to your website so people know how to follow you and get involved?
Sure. I mean, you know, this is just jump onto Macro Hedged. If you can, there's a sign up free trial on the intelligence for 5 days. You know, otherwise we keep everything super low price. I said to you before, Dale, this isn't about charging $1,000 a month. This is trying to get as many people as we can joining us, actually seeing that they can survive. They can do this. It's not about kind of having to roll the dice every day and eventually you get caught out. It's about, you know, what can be that long-term banker. We're working on the basis. You know, I've been in this game for 24 years, and you have as well. And you can't roll the dice every day. You need to be around in 5 years' time, and people don't think past that next 5-lot hit in the mini.
Yeah, you know what? That's what I was saying today. I asked people, have you been trading for 4 or 5 years and still doing it? And anyone who answered yes, I said, you're a survivor.
Yeah.
So you're a survivor, my trading warrior brother. And wow, great presentation again today. I really appreciate you stepping up and being with us today, Adam.
Cheers, Dale. Much appreciated, and a pleasure to be on as always.
Good hunting, and may the 10-year see 3.25 like it did last year by July.
Well, if we see 3.25 by July, I think that's like 900 ticks that trade will make. So.
Yeah, I'll fly over and meet you on your own personal island, and we'll have a drink to celebrate it. Okay, buddy?
That'll be a beauty. All right, cheers. Thank you very much.
All right, take it easy, everyone. That's Adam at Macro Hedged, and you should at the minimum follow him on Twitter and check out his website. That's a wrap for me, guys. You're very welcome, Hamid. Everyone have a great day, and I'll see everyone for Turnaround Tuesday. Remember, don't just count your pips, count your blessings. Adios, warriors. Thank you for hanging out.